Okay, Sandip Agarwal, fund manager at Sowilo Investment Managers, is joining us now to talk about HCL Tech. Let's talk about Persistent as well while we're at it. Sandip, are we being harsh when we're saying HCL Tech could be the accident of the morning in the way the stock will react and saying that the numbers were disappointing?
Good morning and thanks for having me on the show. So, Tamanna, if you recall in previous so many conversation, I have been saying that we are very positive on IT services, but not on ER&D. So ER&D is also called alternatively product engineering services. So while HCL Tech has very low exposure to product, but they do have ER&D exposure. And if you see the fine prints of the number, that is where the problem is. So, I am more worried about companies which have 70, 80 or 100% of ER&D exposure. And since we run a PMS, I will not name them, but I think that massive risk is there in terms of revenue growth for all ER&D companies. What we like and we continue to like for next couple of years will be the IT services space, the traditional IT piece, which will definitely undergrow by 4-5% the ER&D. But the thing is that what the multiple ER&D companies are getting, they are like 4 to 5 times of the IT services, which is not fair. So and secondly, remember that the day Russia-Ukraine things cool off, then these ER&D companies which have benefited immensely by gaining market share from the incumbents there, they will have a tough time for at least 10 to 12 quarters. So I am very negative on a whole ER&D space, and I will only become positive either they come to PEG ratio of 1.5 times or after 12 quarters of Ukraine-Russia war cooling off. Having said so, for HCL, I think except for the ER&D, there is no big disappointment. Remember that what the street was talking about 2 months back, that the industry will decline by 5, 10, 20, 30 random numbers were coming in. And now if you listen to HCL Tech management also, they are saying that we will see 2-3% deflation. And my view is that you should be a little more aggressive there. I count 3 to 4% deflation. So net growth in dollar terms will be 4-5% or 6% for the large companies, and then rupee benefit. So we are in a 13-14% EPS CAGR for 2 years for the IT services firms in the large names. And I think that from that perspective, 1-2 days here and there, but broadly the traditional IT services businesses will do phenomenally well in my view.
All right. So, Sandip, point taken, and you've described that well. I'm just asking, in the bigger companies, relatively speaking, you said that HCL Tech has a sensitivity to this pocket where you think that there will be a high degree of underperformance. Is there anybody else that is vulnerable? And what is the extent of HCL Tech's vulnerability? I'm asking because in FY27 as well, you would have to account for that, right?
No, so I think, what they have given in guidance, 1.5 to 4.5, broadly, you can take the upper end of the guidance. That is what I think, because see, what happens is that the exposure for HCL Tech is maybe 3-4% higher than the other large caps, but it is not like, some of the ER&D companies which are like 60, 70, 80% exposure. So to the best of my knowledge, it will be mid-teens to low than mid-teens, and that is a higher exposure than other large IT firms, but at the same time, it is much lower than the pure ER&D companies. The thing is that the stock, both HCM and HCL, has massively outperformed in last few months the other large cap names, and that is the reason there will be some normalcy to return. But broadly, I am not so much worried about IT services businesses. As I said, 5-6% plus 7-8% delta from EPS for 2 years from currency, total 13-14% story, and you are at broadly that multiple. So I don't see much downside is in the fairly reasonably priced large cap IT names and also mid and small cap IT names. I am worried about insanely priced stocks which are running on high growth from ER&D, and that ER&D growth, I think, is partly due to that war, which once then and market share gain from the incumbent, that will definitely reverse. I don't know when, but it has to reverse at some point of time.
Okay, Sandip, one more big one to go, Infosys. What are you expecting? And today newspapers are reporting about possible leadership change as well. If there is a bit of a negative reaction, do you think that it's a good time to maybe shore up some positions, or you'd stay away from some of these right now?
So I will not give any stock specific call, but let me tell you that I have again told earlier also, and again I'm reiterating, IT index as such is a very good investable idea at this level. You will make at least 13-14% for 2 years, which is a very good return from such a large index and liquid index. So I think the IT index itself is looking very, very good to me. And I think all the negatives, and I would say more than the negatives, are priced in. You go and refer to last 2 months notes of various analysts and journals. They were all talking about 20-30% revenue decline over a period of time. And I think that it will not be more than 3-4% negative impact, and there will be growth. So all the companies will be broadly close to what HCL is reporting, barring one or two which has their own set
Okay.
of problems.
Okay.
So I don't see such risk in this name.
Okay. So the negatives are priced in. All right. Sandip, thanks so much for joining us this morning. Pleasure speaking with you.
Thank you.
All right, let's go straight to